Welcome to the daily update, where I'll go over the action in the market for Wednesday, March 5th, and we'll see how things look for Thursday, March 6th. The big takeaway, at least from the stock market perspective, is that we're still above the 200-day moving average with the S&P 500 and the NASDAQ 100. And we're seeing some improvements internally, but we're still looking negative overall. We'll see if we can maintain price above these long-term moving averages. We've got some economic reports coming out on Thursday, which will be more employment related. And then we have the big employment situation report that will be coming out on Friday. And we'll see if that helps the market to show more improvement or if we're going to chop sideways or see more of a decline. So right at the open on Wednesday, we had a pretty much a flat open. Now it was interesting. Europe was up pretty strong, and the U.S. futures were up strong. We were up about 0.75%. And then as we got closer to the open, we drifted, and we were pretty much flat. It might be that we had been seeing overnight futures strong, and then right after the open, we opened positive and then go down after that. And there's probably some folks that got tired of doing things that way. That's just speculation on my part. I just watch the markets while they're not open to see how the futures are reacting. But it ended up being pretty much flat, and then prices chopped below the daily pivot and unchanged level. There was really no direction, no real conviction, at least when the market opened. And then we started to drift down, but we found support at 57.50, which is a nice round number. Then we saw things start to improve. Prices rose back above the unchanged level and the daily pivot at R1 58.51, and we closed slightly below R1. So we're back above the 5800 level, midway through that roughly, and seeing a few signs that are looking a little bit better. And I'll go through the charts here. We were up 1.12% on above average volume. We're still negative in the short and intermediate term, and that's measured by moving averages. The 20 period in the short term, the 50 period in the intermediate term. We're positive in the long term because we're above the 200-day moving average. And then there's other variables that go in to give that definition. Interest rates going back up a bit after they really had been falling, and the dollar just got hit. It's been getting hit hard lately, and that might be helping things in the stock market because the dollar was going up largely due to these tariffs. And with the dollar coming down, maybe that's stabilizing some things. Interest rates were really going up, which was pressuring the stock market. Now they're coming back down a little bit. So maybe this is helping the bigger picture just a little bit. But this can change at any given time and switch back and turn more negative because of all these different things that are going on with the tariffs, and there's still all of the follow through from President Trump's address to Congress Tuesday evening. Of course, that'll quickly go away and it'll be replaced by something else in the pop news cycle. But folks are feeling a little more optimistic, at least right now. But that could change at any given time. So, some comments that President Trump will give a 1 month exemption to the auto tariffs that go through the Mexican Canadian agreement that was set up last time when he was president. So, that's backing off a little bit there. And we're above the 200-day moving averages, both with the S&P 500 and the NASDAQ 100. Mega caps ended up doing okay. I'll go through the charts later. And that's really what helped things to show some improvement. But we're still above 20 with the VIX. We're at 2193. And when we're above 20, that's when there's a lot of fear in the market. And that's when we see, on an annual basis, negative returns. Now, our list in the short term, this tries to measure momentum, whether we're going up or down. And when it says OS, that means oversold. That's extreme negative, which a lot of times when the bigger picture is still positive, we watch it a lot closer because you're seeing a counter trend short term move in the context of a bigger picture positive move. And so we're working off some of that, but we're still seeing some things on our list here. The CCI 14 and 20, the stochastics, the slope oscillator, that's our short-term momentum oscillator, and we're still far away from the 20 period moving average. And I'll show you charts of all these things. And the TTM squeeze, that's in the intermediate term. It's starting to get to an extreme negative reading, but that's it for right now. And we have this thing called the Hindenburg Omen, which the perma bears just love. And that's why I pretty much disregarded it for a long time because I'm not a perma bear. I like to think of myself as a perma realist. Markets go up, markets go down. Can take advantage of things either way. Well, there's a process with the Hindenburg Omen, and we had the initial signal that came after March 3rd's session, and now we have 30 days to get another signal. Actually, it's 20 trading days. It'll be till the end of March. And I'm not showing the chart right now. I'm just mentioning that we have the initial signal, and that's what I call a non-confirmed Hindenburg Omen. We have to get a second signal to have it be confirmed. So we're just watching that. And if we get another signal, then that'll be confirmed, and that can be a negative thing. Of course, you know the word Hindenburg is not necessarily a positive thing because it's associated with the Zeppelin, the and Led Zeppelin too, but the big blimp that blew up. Okay. And then no changes to the scenario as it applies to the Fed right now. And interest rates, they're not really doing anything. We'll see if the employment situation report coming out on Friday changes this scenario at all. The dollar was down and down kind of big. Right near the end, I'll show a chart of the dollar. And interest rates were up, but it's when we get to that 4.5% level, that's when the market starts to not like this. And we were coming down with interest rates because money was coming out of the stock market into the bond market. They have to buy bonds, and that pushes prices for bonds up, which pushes interest rates down. Well, we're going back up a little bit now. We're at 4.27% with the 10-year yield, where we had been at 4.21%. We're still extreme as far as sentiment. You got a lot of folks that are pretty pessimistic on the market. And when we're under that 25 level, that's when we're extreme negative. And this is when we say, okay, maybe everybody's extreme now. We should look at going the other way at this point. Now, we've been at this point for a number of days, and we're seeing a little bit of an improvement. And things were up in Wednesday's session. So yeah, but now we need to see more follow through from this. Right now we're coming in at 22, so we're under that 25 level with sentiment where we had been at 20, and we're still inverted with the 10 to the 3-month yield curve. And again, I'm not going to keep showing that chart later on. I'm just going to mention it here, and if anything changes, then I'll start to show the chart in the video. We are negative with our trend, and we're getting stronger and we're above 20. So now we have a confirmed trend. And so that's kind of the backdrop that we're seeing right now. But with the up day, our bias, that's usually if we have an up day or a down day, that's positive right now. But I'm still keeping the momentum at negative for the time being. We need to see more follow through first. We did get some economic reports. The weekly MBA mortgage applications index up 20.4%, or last week it was down 1.2%. And then this was a shocker. And this was a little bit of this idea that maybe we're seeing some economic weakness coming into the market. Well, this report kind of reinforced that. The ADP employment change came in at 77,000, half of what they thought it was going to come in at. And last time it was at 186,000. So this really dropped off, and that could be taken as negative. But we see contradictions. We're going to get the initial jobless claims this week that could be completely different than this. And then on Friday, we're going to get the employment situation report, which could be even completely different again. So we kind of have to take this all together. And then this is not real impactful. The S&P Global U.S. Services PMI, the takeaway here is that it's above 51. And that shows expansion. When it drops below 50, as it was last time, that shows some contraction. This was the big one, though. The ISM services, which sometimes it's called the non-manufacturing, It came in stronger than expected at 53.5. So now it's like maybe this economic growth concern that we've been having, we're going to let that slide a little bit. 53.5, they expected 53 and up from 52.8 that came out last time. Factory orders were also stronger than expected, 1.7% advancement there. They expected 1.3%. Last time they were down 0.6%. So here's some charts, and we see this every week. A real pickup in mortgage applications could be the recent decline in interest rates that we're seeing, and that bleeds through into mortgage rates. But there's a whole lot of variables that go into that, weather and all kinds of stuff. Okay, then the ADP employment change coming down, dropping down in about half of what they had expected here. So that's a little bit of an economic concern. And then we look at the ISM non-manufacturing or services, where the total's coming down, but it's still above 50, so it's still showing an expansion. What the market liked here is that we're coming down with prices. If this had been going up, that would produce more inflation concerns. Factory orders year over year coming back up. We've been hugging right around this zero level. Now we're leaning a little bit above zero. Durable goods orders also just a little bit above zero. It's been chopping around, and non-durable goods orders also are positive. So this is showing doing okay here as far as the economy in these reports. Now, other reports that we've already been getting have been weaker than expected, and that's been causing some concerns in the market. Non-defense capital goods orders, you take out aircraft, coming down a little bit, but still above zero. Okay, then we look at the net bullish sentiment. And the takeaway here is the red area. We're really coming down. And this is just how people are feeling about the market. When this goes up, they're more bullish, they're more positive on the market. We've really seen that drop off according to this measurement here. And if you want to stop this and look at other times, what events were going on, and then how people were feeling at that time, and then volatility, this chart comes up from time to time that it's what we pay to be involved in the market. That markets just don't always go straight up, nor do they always go straight down. They're very choppy. And the smaller the dip, the more that tends to happen. And we're kind of in this 5% area right now. We're a little bit over 5% decline from the all-time high that was set a couple of weeks back. But it doesn't feel really good at the time, and you keep wondering, okay, are we going to turn and go lower? And we still don't know the answer to that right now. But in Wednesday's session, things did improve just a little bit, where we see these other bigger corrections a lot less, but man, they can be painful to go through. Okay, then this is the economic surprise index, and then comparing it with the 10-year yield, and it's lagged and inverted, so they shifted all around. But we're just seeing things coming up here with the 10-year yield as interest rates have been going back up. And then you can see when you shift this around a little bit, the connection between this and the economic surprises. And so we'll see if this ends up having some kind of an impact there. And gold is expensive relative to the average US worker's wage. And this is a ratio of what people make versus what the price of gold is, and it's expensive on that type of an arrangement there. And this is a similar chart to what we just saw. The 2-year US inflation swap is actually coming down, and the market implied Fed funds rate, that's coming down too. So it says, despite rising inflation expectations, the market is pricing in more Fed cuts and a lower terminal rate, putting an emphasis on growth. And so the market's seeing something a little bit more positive. Now, the overall attitude has been more pessimistic. We'll see if it is able to shift back over and turn more positive. That's why we're seeing sentiment so low in the stock market right now, under that 25 level. And exposure to equities, still see money going in here, but it has been coming down lately as the market's been under pressure. And then systematic strategic positioning. This is when you have a system and you just follow that system no matter what's going on with the stock market. You might, a very simple example of a system would be dollar cost averaging, where every month you just put in a set amount into some kind of an investment program, and you may not even pay attention to what's happening with the overall stock market. Well, they haven't been doing as well lately because this type of program tends to work better when the market's going up and seeing more of a solid uptrend. And we've kind of hit a brick wall so far in 2025, and even a little bit going back into December of 2024, where the market's really been losing some of that upward momentum. And in that type of a situation, we do see a bit of a drop off, even in a systematic approach to investing. All right, then share of global market capitalization, the US is the biggest. And then you have the Europe taking out UK. Remember, this is another way of saying Brexit here, emerging markets, and then Japan. US is still the biggest. China's not on this list here, but in terms of the traditional stock markets that we've dealt with, US is by far the biggest. Annualized, realized, and bottom-up consensus of earnings per share growth estimates. And over here on the right-hand side, these are the small caps. And it's like, okay, in 2025, how come they're not going to the moon? The projected growth estimates here for their earnings is really high. We're just not seeing them doing very well right now. Where we focus mainly from what I do on the large caps, that's the S&P 500. And this is more steady here, but we are seeing earnings growth anyway. And that's kind of the takeaway from this is all of these lines, especially for 2025 and even looking out to 2026, they're above zero. So they're still projecting earnings growth, even though this will adjust as time goes by. I didn't spend any time on Twitter. Intraday chart here, where we had pretty much a flat open and we just chopped around. There was not an awful lot of conviction, but then we broke down, came down to this 5750 level, and nice round number. And then we were able to come back up, get above the unchanged level. So we went positive, get above the daily pivot, and work our way up to R1. And these pivot points, the nice thing about them is we know what they are even before they happen. And I post them on the YouTube community tab each day, uh, a daily chart, and then a chart like this that has intraday pivot points that you can keep an eye on. And we close just a little bit below R1 here. And pretty much flat right now in the initial overnight session. But you can see in here this kind of light blue area where we were quite positive about the time Europe opened. And then we just started drifting down, 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 down. And then we ended up having a flat open in Wednesday's session. So things had been more positive, but it kind of wore it off before the open. We're still negative here. The blue line is below the red line. We want the blue line above the red line, meaning growth is outperforming value. And obviously, there's a mistake right here. Okay. Take my word for it. The red line is value, the blue line is growth. All right. And we're seeing subtle improvements here where the intraday growth to value ratio for the S&P is starting to go back up, looking a little healthy right now. We need this to continue to go up to turn more positive. And then we look at this on an end of day basis where growth was up, but up less than value. It was up quite a bit more for the mid caps, but up about even to a little bit less with the small caps. So then we look at some end of day charts where we're still in a longer term uptrend with small cap growth to value, and we fell underneath the 200-day moving average with this ratio. Now we're coming back up, but you can see the index just falling off a cliff here and not doing really well. A little bit of an improvement with mid cap growth to value, but also a lot of weakness recently in the index. And we've been holding up okay, but not really showing any outperformance here with S&P growth to value. And even though the S&P's been under pressure lately as well. And a little bit of a tick up, but also some recent weakness when we look at discretionary to staples and then do the ratio down here on the bottom. So slight improvements, but nothing too dramatic, at least to this point. A little bit more of an improvement here. We look at a growth ETF and a value ETF and then do a ratio. We had dropped below the rainbow. Now we're starting to come back up slightly. And we're still above the 200-day moving average with the large cap growth ETF. So this support level is also holding for the large caps. And we're in a negative trend though, even though the red line's coming down, the red line's above the green line. So that's why we're negative. And we now have a trend that's confirmed because we're above the static level at 20. We're also above the moving average, and this is getting stronger. And we're also in a short-term negative trend with the red line above the green line, above 20, above the moving average. So it's a strengthening trend as well. We're above average with volume. And then once a week, and this looks kind of funky if you've seen me post this before, we get a thing called the Investors Intelligence Survey. And these are people that write newsletters and make recommendations. And I really only pay attention to this if we get above 3 or below 1. And we're kind of at the midpoint right now. They're not necessarily overly bullish, which would be above 3, or bearish, that would be below 1. We're still seeing fear here with the Ulcer Index, which is a sentiment gauge that we follow. The big one that we follow is the VIX, and it's coming down, but it's still above 20, both with the line chart here and with the bar chart. Coming down with the VIX of the VIX, which measures the volatility of the VIX, which is a volatility measure in and of itself. I know that sounds crazy. But so we're coming down a little bit, but we're still above the moving averages here. The momentum of the VIX is still up. And we're still getting a high reading with the skew index. And that's a variation of the VIX. But we've been seeing this. We've been up in this red area for a long time. Okay, and we ticked down just barely over here with this fear gauge, and we came down with this other fear gauge. So there's some fear that came out of the market in Wednesday's session. This is an area that we're keeping an eye on, though. This is the spread between risky and not as risky bonds. And this is an inverted version of the chart I just showed. When there's no fear, we get really high readings on this inverted scale. Well, this has been coming down, and that's a little bit of a concern to us. We're actually breaking below this level that we saw late December into January. If this keeps falling, that means that the bond market is perceiving more risk. And this is why I have it in the sentiment area. It's how people are feeling about things. And we declined with the daily chart of the equity put call ratio. We're slightly going down with the 5-day chart, which is positive, and barely ticking down here with the 10-day chart, which is also considered to be positive, but not showing an awful lot of conviction right now. And we're flat to slightly declining with volatility risk premium, but we're still slightly above this band as there's been an increase in fear lately. Still holding up fairly well with the advanced decline line based on price. We've been trailing along, even with the S&P coming down, which is showing that there's been some rotation from growth back into value. That's why the price area has been holding up better. Now we want to see, is there going to be a shift back over from value back over to growth? It's too early to tell that, and we just watch that on a daily basis. And a little bit of a tick up, but we're seeing more volatility here with the advanced decline line based on volume. But both are still above advancing moving averages. So longer term, they're positive. We improved here with our advancers minus decliners over a 10-day period, but we're still below zero. And this is interesting, where we saw an explosion of new highs after Tuesday and an explosion of new lows, almost nothing in Wednesday's session. So we're starting to roll over with the 10-day chart and, excuse me, the 5-day chart and the 10-day chart here. So this is showing a little bit of internal weakness. And we're coming back above zero with our advanced decline ratio. The blue line is short term. The red line, which is really hard to see, it's intermediate term. They're still both above zero. So that's switching back and looking more positive there. We're still above the moving average with accumulation distribution. So this is still taking us positive, and we ticked up. But we're still declining with our second smart money indicator. The histogram went down and the red line is going down. So this is negative, where we're turning up and trying to go back above the moving average with the chicken oscillator. So we're seeing a mixed picture with our three smart money indicators. We're negative here, the vortex, the red line is above the green line. And not seeing an awful lot of change here with the cumulative advanced decline line for the S&P, just chopping along here. When we look at price, seeing a little bit more volatility based on volume. The cumulative advanced decline line for the NYSE, we were up, and so that showed some improvement. We're trying to come back up to the moving average here with our regular NYSE advanced decline line, as well as this other NYSE advanced decline line. I show two of them because they're calculated in a slightly different way. And we break it out based on common stock with price. A little bit of a tick up here, a little bit of a tick up when we just look at volume. And I'm saying this is positive for the S&P because we're above the moving average. Where we have some damage to repair here. With the NYSE common stock, it ticked up, but it's still below the moving average. We're seeing that same thing with the mid caps, and we're even further below the moving average with the small caps. We're still negative here. This is a 5-period moving average of the highs minus the lows across the broad market. This continues to be below zero and is declining. Improved a little bit with those stocks in the S&P above their 20-period moving averages. That's short term, but we're still below 50. So this is negative. A little bit of a tick up with the 50-period moving average study. A little bit of a tick up with the 100-period moving average study. But this is kind of encouraging right now. We had come down to almost 50 with the 200-period moving average study, and that's long term. If we can stay above 50, that will help keep the long term more positive. And if this can go back up, that would show that in a longer term perspective, things are improving. So we're coming right down to the 200-day moving average, and so far this is holding. We haven't even gone below this on an intraday basis, and that's what we're watching right now to see, are we going to break below this? That's one thing. But if we close below it, that's going to be kind of a big deal. And it's going to have a tendency to turn things more negative. Then on the bottom, we are above average with volume. We saw a little bit of a tick up with the 20, 50, and 200 period moving averages on the S&P. But you can see as we've been going down, these have been drifting down as well as it's picking up this weakness. We're still far away from the 20-period moving average. We're under it quite a bit now. And that's what the boom indicator tries to measure, the distance from price to the 20-period moving average. We had been far away with the 50-period moving average study, but we're coming back closer now. And we're still above zero, though, with our distance to the 200-period moving average. And we're no longer extreme. We bounced up just enough here with the Stochk RSI and Williams percent R. Even though we're ticking up, we're still extreme with the CCI 14 and the CCI 20. These are our short-term indicators that we follow. They're very touchy. We're no longer extreme negative in the short-term stochastic. We actually came down and we're still extreme negative in the intermediate short term. We're also extreme negative in the long short-term stochastic. Bouncing up a little bit where we were coming down to the Keltner band here, we came back up a little bit with the force index, but it's still negative since we're below zero and it's red. This is the condition of the short-term trend. We're still below these lines and the lines are going down, so that's negative. We're still below the 20-period simple and exponential moving averages. That's negative for the short term. We wore off a little bit here with our standard deviations chart. After Tuesday, we were in the -3 channel. We came back up into the -2 channel. Balance of power still below zero, so that's negative. And I usually don't only show this in the deep dive video that I do. We were getting really close to the 200-day moving average here. Now we're coming back up a little bit. We'll see if this can continue to hold. We're negative with the go, no go when it has the dark purple lines there. Coming up a little bit, but still dealing with the lowest low value on this chart. That's negative. And I'm just kind of keeping some real loose measurements here. We're down now. It's about 6.77% from the low that we set, from the all-time high that was set. And some of the smart money will use the percentage basis. And this is what goes into the definition of is this a decline? Are we actually, if we get over 10%, then that's a correction. If we go over 20%, that's a bear market. So we just keep an eye on these things. And we're starting to get extreme negative here with the TTM squeeze. This is still negative and declining. And just to give it more perspective, I have a longer term look at this same chart. We could still go down below the black line. I put the black line on here, so there's nothing magical about it. I just use it as a reference point. And we're still moving pretty quickly here with our standard deviations chart. That just means that we're going fast over the last 10 periods. Ticked up a little bit, but still negative with the ease of movement. We're still negative with the Arun since we're below zero. This is the oscillator that measures the difference between the red line, which are sellers, and the green line, which are buyers. And ticking up a little bit with the NYSE McClellan oscillator, but still below zero. And we're still declining with the summation index for the NYSE based on price and volume. Improving, but still below zero with the S&P McClellan oscillator. So we're still declining based on price and volume here. So not we're seeing some slight improvements, but it hasn't switched back over to positive yet. This is looking a little more positive. The swing and trading oscillator, we're ticking back up, but still below zero based on price. Turning back up ever so slightly based on volume, but still below zero as well. Momentum is still negative. The PMO is going down. Based on price, we're going down as well as volume. Then we do studies of those stocks inside of the S&P using the PMO. The PMOs that are rising tick back up a little bit, but we've been around this neutral area for most of February anyway. We're still declining here with the buy signals, and we're rolling over with the PMOs that are above zero. Now we look at the condition of the intermediate term trend measured by 50 periods here. Still below these lines, the blue line and the red line are going down. We're still below the simple and exponential moving averages based on 50 periods. And we broke below the 100 period moving averages. Now, if we do see more follow through strength, we'll be watching some of these to see if they act as overhead resistance. And looking at all the moving averages together, longer term, we're still positive as long as we're above the 200-day moving averages on a closing basis. And we're keeping an eye on these anchored moving averages here, coming down to this orange area, which is kind of an intermediate term low. What I've really been watching is this blue, kind of light blue line here. That's more of a significant low that was set almost a year ago. And then this is an anchored moving average that often will provide some kind of support. And so far, we're still above that. And we've gone from negative to neutral with the Elder's Impulse system for the S&P, but we're still negative with the parabolic SAR. And momentum is now getting extreme with the slope oscillator. We're still going down here. This is short term. Then more short to slightly intermediate term is the MACD. That continues to be negative. And then I have two short term, three intermediate term, and two long term oscillators. They're all negative. The Copic curve, another momentum oscillator, is also negative. And we're still looking a little bit more negative here with the Sean trend meter. We were flat. When we get extreme is if we go down into this pink area. We improved, but we're still below 50 with the money flow. We also improved, but still below 50 with the ultimate oscillator. We improved, but we're still below the moving average now with unbalanced volume. And we improved with the RSI 14, but we're still below 50. And we're no longer extreme negative with the RSI 9. That's short term. And we're watching this. This is the mass index. And there's three criteria to this signal. We're hitting number one. That's when we go above the red dashed line. Criteria number two will be when we go above the blue line. And then criteria three will be when we come back down and cross below the red dashed line again. And this suggests a reversal. Now, in this context, we've been going down, which is setting up a signal for this. So if it was to trigger, at least at this point, it would look like, okay, it would see a reversal to the upside. But we don't know that. We have to use other charts to help us determine what's actually happening. We're also getting close to a crossover buy signal with the Pring bottom fisher as well. But we're still looking negative with the bullish percent index. We're below 50 and declining. We continue to decline with the NYSE bullish percent index, and we were flat but below 50 with the NASDAQ 100 bullish percent index. Watching this Ichimoku cloud here, we're still below the green cloud, and we're still going down with the red line and the blue line, although we ticked up with the short-term green line here. And we're keeping an eye on possible fib retracement levels. Now, the reason why they're possible is anytime we set a new all-time high, this needs to be readjusted. It goes back from the low that was set a year ago to whatever the most recent all-time high was, and then it draws in these retracement areas here. And we'll see. We're not there yet. We're just keeping an eye on this for the time being. We're still negative when we look at different ways of measuring the trend. When we look at here at the Heiken Ashi, that's still negative. We're negative here with the Kegi chart, but now we're pointing up. instead of pointing down. We're negative with the Renko chart since we have the red blocks there, and we're still negative with the three-line break. Long term showing a little bit of an improvement with our long-term moving average based on 150 periods, but we're still below this blue line. That's kind of the line between positive and negative. We're still above the blue line with our 200 period moving average study. And we're still negative in the short and intermediate term with the S&P, mid caps, small caps, and NASDAQ 100. Still positive longer term. And bonds are positive in the short and intermediate term, still negative in the long term. This is based on price. The dollar's just been getting hammered, though. It's in a downtrend in the short and intermediate term, with commodities being negative in the short term. And the two sectors that ended up being lower were utilities and energy, and these are often considered to be more defensive. Where we're seeing, things like materials, this is more cyclical. It cycles with the economy. But we saw discretionary. That's one of the growth areas that we like to see do well. Technology, another growth area, and communication. When these three areas are doing really well, that's when the market's doing really well. And here's just a look at the alerts that were triggered, and it starts at the bottom. And then this is right after the market open, and then we go up, it ends up being when the market closes. And then, like oil, this was quite a bit later here, but seeing some red, seeing some green here. The S&P getting back above 5,800. Let's see, the NASDAQ got above 18.3, then it dropped below 18.2, then I'm 18.4, 18.5, 18.6, woohoo. And then the tech sector had a BPI cross below 30, and it's been under pressure lately. We'd like to see this doing better than it has been. The healthcare sector had a BPI cross below 50, which could actually be more positive for the market because that's a defensive area. Energy had a BPI cross below 30 as well. This could also be positive. The communications sector having a BPI cross above 50, showing a little bit of strength there. All right, the Dow coming back up to this S1 pivot point, below its 50-day moving average, but still above its 200-day moving average. Going from negative to neutral with the diamonds, which is the ETF for the Dow, where we did reclaim the 200-day moving average with the NASDAQ. Now, that held up last week. In Friday's session, we bounced up off of this 200-day moving average. We lost it on Monday, but we've been able to get that back. And we're still above the 200-day moving average of the NASDAQ 100. That's another one that we'll be keeping an eye on. And we've gone from negative to neutral with the Qs. That's the ETF for the NASDAQ 100, but the momentum for the NASDAQ 100 is still negative. And this is also the Qs here showing how the 200-day moving average, at least to this point, is still holding. Small caps, they were up over 1%, but they just been going down ferociously here. Also, the other small cap index, the Russell 2000, saw a bounce, but still a lot of damage that needs to be repaired. Gone from negative to neutral with the Elder's Impulse system for the small caps. Mid caps also under a lot of recent pressure, coming back up and closing slightly above this S1 level, but below their 200-day moving average. And going from negative to neutral with the Elder's Impulse system for the mid caps. Financial sector, which just got hammered in Tuesday's session, came all the way down and actually started to break below its 50-day moving average. Saw a bit of a bounce. It was up 0.58% on Wednesday. We want this to do well. Another area that's been causing some concern is the bank ETF. This is inside of the financial sector. We broke below the 50-day moving average. We're still above the 200-day moving average. It will be even more positive if we could get back above that 50-day moving average. The Wilshire also, this is a broad market measure, still holding out above its 200-day moving average and also holding out above its 200-day moving average with the total US stock ETF. So there's a lot of 200-day moving averages that we're watching. These are more general. These are broad-based. The ones that I'm focused on, of course, is the S&P most of all, but because there are stocks in both indexes, I'm also watching the NASDAQ 100. And we're seeing a little bit coming down here with the staples to tech ratio. When this is really spiking up, that means the market's getting more defensive. If this will continue to come down, that means it's switching back over and being more offensive. But just one day change, that's not enough. We need to see an overall trend with what's happening here. Still hanging out above the 200-day moving average with the FANG index, which are the really big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia. And let's see, Apple was down slightly, still below its 50-day moving average. We were up 2.24% with Amazon. Right now, that's bouncing off of its 200-day moving average. Microsoft's in a downtrend. The blue line's below the red line, even though it was up over 3%. It's got some damage to repair here. Google is also under its 200-day moving average. It was up 1.23%. Coming back up a little bit above its 50-day moving average is Meta. It was up 2.57%. Nvidia was up over a percent, but still needing to come back up to its 200-day moving average. And dealing with its 200-day moving average is Tesla. And if all these stocks could really start to do better, that would really help the market. Netflix was up 1.89% and came down to its 50-day moving average and then bounced up off of that. And we're still seeing more of a short-term deterioration between US stocks and world stocks. That's the 10-period correlation. It's going down. We're also seeing more of a deterioration here with the longer-term correlation as well. Oil is dropping, which is not inflationary, but if it keeps going down, people are going to be like, oh, the economy's weak. Nobody's getting oil. You can never make some folks happy, no matter what you do. But this coming down, it's actually more in a downtrend right now. This is the dollar. You see, we were up into the 107, 108 range there, and just boom, it just took a big dive here. And it's actually dropping below its 200-day moving average. And we went back up above the 200-day moving average with the 10-year yield, and we're coming down a little bit with the 10-year based on price. Seeing a little bit of improvement, but still negative here when we look at our growth to value ratios with the Qs to S&P, discretionary to S&P, large cap growth to large cap value. The large caps, mid caps, small, and actually bounced back up really big here with the small caps, but still below a declining moving average. This is another offensive versus defensive ratio that we look at. We've been really going up as staples have been outperforming the S&P. It ticked down a little bit on Wednesday. If this can continue to fall, that would be more positive for the S&P. So what's our outlook for Thursday? We're still negative in the short and intermediate term, but we're above, and I should have put 200 here, above the 200 period simple moving average. And that's a big deal. We're going to get initial jobless claims and continuing claims. The trade balance will be coming out. Productivity and unit labor costs. How much are folks producing at their job and how much are they getting paid? All right. And then wholesale inventories and then anything geopolitical. And there's so many things going on right now with the new administration and the tariffs and the trade wars and yeah, and who knows what'll happen on Thursday. Who knows? All right, and then we'll have the employment situation report on Friday. This is another look at the economic calendar for this week. Seasonality, we're neutral to negative with the Dow for March 6th, where we're flat out negative with the NASDAQ. Now this measures back to 2002. What we look at on this chart is the solid lines are what historically happens. The dashed lines are what happens in a post-election year. So there's a lot of different ways you can look at this. And we are seeing a little bit of a downward move with the green dashed line, but then we see a little bit of an up move here for a couple of days. So again, it's like I don't use this to make decisions, but we use it as a guide just to know what typically happens. And typically, the first half of March is the second best performing part of the month, going back to 1950. The second half does okay, but not as good. And then it says good riddance, February, better times could be ahead. Typically, after the post-election, March tends to be up, followed by a better April and not quite as good of a May. And this, again, this will be quickly outdated here. This just depends on how you look at it. The black line are all post-election years and how we perform throughout the year. Then the pink line are incumbent party loses. That's what happened. And that's when we see a little bit more weakness. So we're actually getting closer down to this pink line. And then you have the aggregate. This is everything taken together here. and that's green. And then this, so far, when this chart was updated, how we've been performing in 2025. And then it says it could be choppy from once we get through February, through March, and into April. We don't see any real conviction according to this chart. Where we do tend to be positive for March, and we're up 65% of the time. Okay, we're seeing some mixed signals here when we look at our smart money indicators. We're back to looking more positive with accumulation distribution because it's above its moving average and it ticked up. Where the Chaikin money flow is still going down, but now the Chaikin oscillator is turning and going back up. So that's a mixed picture there. We're still negative with the S&P and NYSE McClellan oscillators and summation indexes. And the reason why these are gold is they're considered primary indicators. The parabolic SAR is negative, the bullish percent indexes are negative, and then I look at them and they're really important, but they're white because they're not considered a primary indicator, in my opinion. We're still negative when we look at momentum and the ease of movement, money flow, and ultimate oscillator. They're white, they're called secondary indicators, in my opinion. The vortex is a primary indicator. It's still negative, and the momentum for the NASDAQ 100 is also negative. Positive side, when we look at the longer term growth to value ratios, they're still positive. It's in the shorter term where we've been seeing this weakness and actually turning a little bit more negative. And then we're going back down with the 5-day and 10-day equity put call ratio charts. And we're positive here because of the S&P. It's above the moving average with our advanced decline line studies. The swing trading oscillator is improving and starting to turn more positive. The financial sector is positive, but we're concerned because the bank ETF is under its 50-day moving average. So our conclusion, we're negative in the short and intermediate term, but we're still positive in the long term. That's why we're obsessed with the 200-day moving average right now. In the short term, we're negative, seeing some improvements, but we're still oversold or extreme negative or showing negative momentum, depending on how you look at it there. We're just flat out negative in the intermediate term, with a really no list to speak of. In the long term, we still continue to be positive because we're above the 200-day simple moving average, and we're still working off of a golden cross, which was triggered back in 2023, and that's been the uptrend that we've been in ever since. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.